We begin with the big issue. Is bad news just bad news? Samana of Wells Fargo saying this: the economy is slowing gradually enough that economic surprises may trigger only consolidation. Election and geopolitical disappointments could trigger larger pullbacks. Alongside Samir, we're joined by Krishna Memani of Lafayette College. Gents, great to catch up with you both. Samir, first to you. Is bad news just bad news? And could you define for us this Friday, when we get payrolls, what bad news looks like?
Yeah, John, as you know, we've been cautious for some time, and a lot of that caution has been driven by the fact that the Fed raised rates so precipitously over the last couple of years. And although those kind of long and variable lags might be a little bit more long and a little bit more variable this time, we've thought for some time that the economy will slow. As far as Friday goes, I mean, the tricky part is, there's going to be some who are hoping for rate cuts to come back to the forefront. For those folks, they'll clearly want a worse number. I think the tricky part for us, though, is we tend to be more fundamentally driven. And if you do get a worse number, at some point you do have to deal with the slowdown on the way to those rate cuts.
Krishna, let's talk about what bad actually is. 125 over at Bank of America. That's bad news. Apparently, Stuart Kaiser of Citi, who'll be catching up with later this week, headline payrolls below 150 would be worrisome. What is bad this Friday?
Well, so I don't think 150 would be such a bad number. I think if you kind of put 150 in conjunction with GDP now coming down from 3% to 1.8, you can make that case. But I think in the sequence of things that we have seen and the variability in employment, I don't think 150 is a really bad number. The point I would make to kind of counter what Samir was saying was, there will be a slowdown, and we have been hoping for a slowdown. But there is absolutely nothing in the data that indicates that things are actually slowing down in any perceptible way. I think the Fed would like to see that, but there is really no evidence of that just yet.
Hold on a second, Krishna. A lot of people would disagree with you. Even Neil Dutta is actually getting not as constructive as he has been in the past, partly because what you are seeing under the hood is ISM manufacturing coming in lower than expected. The U.S. Economic Surprise Index falling to its most negative going back to 2019. Why is that not enough to say that things are slowing?
I mean, things are certainly slowing from a very rapid pace. But I think if you have your growth rate at 2% at this point in the cycle, after 550 basis points of rate increases, I don't think that is really would be considered a meaningful slowdown. That's the point I'm trying to make. That is, if we stay at 2%, which is what Neil says, he DM'd me at 2 a.m. last night to kind of confirm that. The fact is, if it is at 2%, then that's really not a slowdown at this point in the cycle.